What you're seeing in the stock market right now is a massive surge, but behind it lies a meticulously planned, unprecedented national strategy. It's going to rise to a point that will leave you dizzy. China's capital market has seen an epic surge for 5 consecutive days, breaking multiple historical records. The Chinext index rose by 42.12%, the SCSI component index by 30.26%, and the Shanghai Composite Index surged 575 points in one go, even causing the Shanghai Stock Exchange trading system to crash. Veteran investors with decades of experience have never seen anything like this. Just a week ago, it was shunned, but now it's the focus of national attention. What exactly is happening behind the scenes to cause such a frenzy? Today, I'll take a few minutes to unveil the mystery for you. Everyone knows that in recent years, doing business domestically has become challenging. Unemployment is rising, consumer spending is weak, and making money is getting harder. Adding to this, declining housing prices and stock market dips are shrinking people's assets, and pessimism is spreading throughout society. This is a very dangerous signal. This led the former governor of the central bank to declare at the Shanghai Bund Financial Summit that China should now focus on combating deflationary pressure. This indicates that there are signs of deflation in our economy. So what should be done? Massive money printing is necessary to address this, but where should this liquidity be directed? In the past, we channeled liquidity into real estate, meaning that much of the prosperity over the past 20+ years largely relied on rising housing prices. If you don't believe it, just ask people around you. Hasn't most of the wealth accumulation come from the appreciation of property values? But real estate is a long-cycle industry. It can't remain prosperous forever. No country in the world has achieved lasting national wealth solely through real estate. We can say that China's real estate sector has already fulfilled its historical mission for this cycle. So, where else can replace real estate as a reservoir for liquidity? Theoretically, there are two options, the real economy and the stock market. But the core issue in the economy right now is weak consumer spending, excess market capacity, and pessimistic expectations for the future, making businesses reluctant to expand production. So even if you lend money to businesses and keep lowering interest rates, they're still hesitant to borrow. Therefore, addressing the issue from the production side won't solve the real problem. After careful consideration, the solution still lies on the consumer side. By increasing people's incomes, we can boost their willingness to spend. This marks a fundamental shift in economic stimulus policies on September 24 and 26, compared to previous approaches. Thus, the stock market has become the most suitable place for this round of liquidity infusion. Why is this the case? There are 3 levels of strategic considerations involved. The first level, addressing internal economic issues. Firstly, when both domestic and international observers are expressing doubts about China's economy, building confidence becomes crucial. The stock market is often seen as a barometer of the economy. Therefore, boosting the capital market and driving up stock prices helps to strengthen confidence among citizens and foreign investors in China's economy. At the same time, capital is the lifeblood of the real economy. Elevating the stock market is equivalent to injecting funds into enterprises and clearing their pathways. Naturally, businesses become revitalized, employees' incomes are secured, and ultimately, the entire society benefits. Secondly, the stock market is the most direct way to increase public income. Just look at the past 5 trading days. If you had simply invested in index funds, you would have earned an average return of over 30%. That means if you had 1 million yuan, you could have made 300,000 yuan in just 5 days. Plus, the stock market has high liquidity, allowing you to buy and sell freely to realize this wealth quickly. Whether you recovered losses from being previously stuck in the market or made smart investments to profit from the dip, your confidence to go out and spend will be completely different. I have to say, there must be experts guiding this strategy. The decision to drive the stock market up sharply right before the National Day holiday will undoubtedly lead to booming holiday consumption, and when consumption thrives, all industries flourish. Thirdly, the majority of stock investors in China are part of the middle class. This group is large in number and has the strongest spending power. However, during this economic slowdown, the middle class has suffered the most significant wealth losses. Therefore, this stock market surge is essentially the country giving money to the middle class. Once they recover their losses or make a profit, they will resume spending. However, consumption means spending money. When some people spend, others naturally make money. And when people make money, they will spend again, creating a positive cycle. Whether it's the workers at the bottom or the businessman running companies, everyone will benefit from this wave of dividends, ultimately revitalizing the entire social economy. The second level, the strategic competition with the United States. Firstly, although the United States began cutting interest rates on September 19, it is now approaching an election. If Trump is elected, there will be significant uncertainty, as he was the one who initiated the trade war with China back then. Additionally, his trade protectionism could easily drive up U.S. inflation again, which might prevent the U.S. from continuing to cut interest rates and could even force it to raise rates again. At that point, we would once again find ourselves in a passive position in the trade war. This is why we are racing against time and must seize this window of opportunity. It also explains why the policies this time are so strong, frequent, and quickly implemented. This includes the high-level economic meeting, which was unusually moved up from the usual November to September. To achieve quick results, across all industries, only the stock market can deliver immediate effects. Moreover, the stock market has low entry barriers and strong participation. You can see that after a few consecutive days of gains, the enthusiasm for discussing stocks has surged nationwide. Some people are even hoping the stock market won't take a break during the National Day holiday. Secondly, it increases the cost for the U.S. to buy our assets at a low point. As soon as the U.S. cut interest rates, we immediately introduced significant stimulus policies. Before Wall Street could react, China's stock market had already surged for 5 consecutive days. When these Wall Street investors try to come in and buy at the bottom, the cost has already risen significantly, effectively turning them into contributors to our gains. You might think that if the market has already risen, Wall Street capital wouldn't dare to come in. Rest assured, capital operates based on expectations. Without a promising future or strong expectations, even leading stocks won't attract capital. But once expectations change, capital will rush in. The principle of buying on the rise, not on the fall, is exactly how it works. The third level, guiding capital to flow into China. With the U.S. cutting interest rates, capital from around the world is eager to move and is searching for value opportunities. Looking globally, the stock markets of major economies this year have reached new highs, but their cost effectiveness is not favorable, with many even showing signs of a bubble. However, after 3 consecutive years of decline, China's stock market is now at historically low valuations. Furthermore, the total market capitalization of China's stock market is very small, only about 1/5 of the U.S. market. This is not aligned with the status of the world's second largest economy. Therefore, there is enough space and scale to accommodate large foreign capital. Additionally, Chinese companies have over $1 trillion in unconverted foreign exchange assets, which will also be repatriated to China when the opportunity arises. The reason these capitals haven't flowed into China in the past is twofold. First, the US dollar has been in an interest rate hike cycle, and investors preferred to stay in the US to earn interest. Second, doing business in China has often led to losses, with even government bonds and bank savings offering very low returns. But now the situation is reversing. With the stock market on the rise, the profit-making effect has emerged, and capital is following suit. Moreover, to ensure the safety of capital, on September 25, we conveniently launched the Dongfeng 31 missile into the Pacific. This was a message to global capital, showing them that China is strong and encouraging them to come in quickly. Of course, there is another underlying purpose behind this, which is to hedge against the pressure of the rapid appreciation of the Chinese yuan. With the U.S. cutting interest rates and external capital continuously flowing into China, the yuan will face pressure to appreciate rapidly. Just a few days ago, it had already returned to the 6-level range. However, a rapid surge in the exchange rate is not favorable for foreign trade exports. So, at this time, by printing a large amount of money, we can both stimulate the economy and hedge against the pressure of yuan appreciation. It's a classic case of killing 2 birds with 1 stone. The high-level economic meeting, the joint press conference of the 3 core economic departments, and the Dongfeng missile launch after 44 years, along with the display of electromagnetic catapult details, these recent consecutive major moves are all telling everyone that China's economy is starting a dramatic counterattack. Alright, this article is from the Bingyun Strongman Think Tank 1000 article collection. Due to content restrictions, the full text cannot be published. If you would like the complete version, please follow and then check the pinned video on the homepage.